3 o'clock, time for our Kruse quarterly call with myself, Stuart Kruse, and John Brick, CFA, who's Kruse Asset Management's Chief Investment Officer. We're here for the quarter to tell you what we think is going to happen in the next, 3 to 12 months or so, what the moves we're going to make in order to protect your portfolio, potentially take advantage of the opportunities in the marketplace. And without further ado, let's get started. Any comments on that introduction, John, or ready to take it away?
That was flawless.
Okay, so I think we're going to start with just how the major asset classes have performed year to date. Some of them have been a little bit unexpected, but some are kind of what we expected. It's been hidden, but John's going to discuss how the major asset classes have done. So why don't you hop on that train, John?
Major asset classes. So I guess I could quickly, should I start with what they look like now or what they've done year to date, performance-wise?
Yeah, I don't know, maybe year to date.
All right. So basically the landscape is tough. What we've seen in 2022 and so far in 23 has been very bifurcated, and the future over the next year, I would say, is a little bit more interesting. So let's start with the safe havens, or the classic safe havens, the bond aggregate index. Flat for the year, down 1.8. If you had any duration on there, do you have long bonds? You're down 11%. And this will be meaningful in a quick comment that we'll look at with some fundamentals maybe 10 minutes from now. Anyways, so the fixed income alternative, or the fixed income, which is also often an alternative to equities, has gotten smoked. Let's look at some commodities.
By smoked, what do you mean?
Smoked, it's gotten crushed to the downside. Gold has been flat for the year. Silver down 12%. The aggregate commodity index was it up 1%? I had the screen hiding. Okay, up 1%. All right, so we basically can't hide anywhere. There's no real money to be made so far from the commodity and bond index, and we can come back to the bond index in a minute. We can look at some of the developing world stock markets. The emerging markets are down 1% year to date. The ACWI, which is developed indexes globally, are up 8%. Let's turn to the U.S. The S&P, which has been the bright spot, has been up 12%. The interesting thing about the 12% year-to-date total return has been that it's largely consisting of the top 7 stocks, Microsoft, NVIDIA, etc. And I'll show you that because if you equal weight the index, the equal weighted index, which is the average price of all 500, as opposed to just putting it on the market cap weighted basis, which Stuart, I think, has a chart later on of this, but we're flat. So no money to be made if you had a diversified basket of stocks. The Russell, let's look at the Russell, which is the small cap. The S&P equal weight and the Russell are often looked at as kind of the same. It's the broad-based index that looks at the stock market in aggregate, not just market cap weighted for the big tech. Small caps flat on the year. If we go into the specific sectors of the market, mid cap, small cap. So I just went over small cap, flat on the year. Mid cap, 2% up. Large cap value, down 2.4. And again, the large cap growth, which takes into account the big 7 tech stocks, you're up 31%. So the only place to hide across broad indexes have really been anything related to the large cap index, the Qs, which is the same graph, the same asset class. And if you own the actual SPY index, which we will circle back to the SPY and the S&P index in a few minutes. But that's the broad overview of what the return profile has been. So it's been pretty muted from a position of return. And I'll quickly go over this to not be long-winded, but one of the things we do is try to look at cutting risk and looking at what has been in favor and out of favor based off some technicals. And it quite quickly is looking at below index moving averages, below a histogram, and below an RSI. We'll spare you the details. But as you can see, when things get red and they're below the index moving average, you want to stay away. Here's another example. Here's another example. And across different asset classes, you can see when you're red and you're below the index, you stay away. When it's green and above, you buy. What's more interesting, despite the fact that we had some places in here that had a positive return, where are we going from here? And where are we going from here? Well, here's the S&P. It looks like it's peeling back down. And that's, again, that was one of the better indexes out there. Gold.
Looking at that chart, that looks like a double top, and explain to people what that means. Did we break through that previous high or no?
Yeah, the double top. So the former high with the COVID stimulus ramp was right up here, and we just missed it. And so one can say that's a lower high. We did not break through it, and we started to peel back down. So
that's traditionally a technically bad sign if you fail to reach the top. And you could suggest maybe there would be a lower low, which would mean below that more recent low. But we'll talk about that a little bit more.
So again, I'll come back to this S&P index in a minute, but I'll spend 30 seconds just paging through some of the major asset classes and how they visually look. And then I will turn it back over to Stuart for his comments. So like I said, the commodity index looks like we had another double top-ish or a higher, lower high, and it looks like we're breaking back down. Silver looks like you want to avoid that. Gold, we want to avoid. If we look at the AG, which is the aggregate bond index across all different types of fixed income, very low. Looks like it tried to break out and broke down. We've stayed away, largely stayed away. We had a little exposure, but this isn't looking great. The Russell, the broad index, small cap, is almost back to its lows of October in 22, believe it or not. Looks like it broke again, heading back down. Emerging markets, bad. ACWI, bad. You get the gist. I said 30 seconds. I'm probably on time. So basically what this tells us is that we're monitoring a lot of asset classes. We're very in tune with what has happened in the past in 22 and 23. And what's more importantly, what Stuart will talk about, some of the recession pricing and on the horizon. We've cut a lot of risk. We've stayed very conservative, and we have not chased. Just because the index was up and hot, we did not chase it. We've cut risk, and as you can see, things are rolling back over, and we feel very good about our defensive position. Turn it back to you.
All right, John, if you let me share my screen as well. Pick over here. So here we have yield curve. So John just talked about equities and a variety of different areas that how the market's performed. What I'm going to focus on is the yield curve. So what this is what is the rate that you get when you give the US government your money for X period of time. So how we're going to read this chart. Back in 2021, if we gave the government our money for 3 months, we basically got no return. If you give it to them for 5 years, you got 1.3%, 20 years, 1.9. This curve, the way this looks, where it kind of goes up and slants up to the right, is the traditional version of the curve. That's a normal yield curve. What we see now, what we have seen for more than a year, is these shorter rates are getting a higher rate of return. So back in 2022, the 1 year was paying 4.8%, while the 10-year was paying 3.9%. That is the definition of an inverted yield curve, or really they look at mostly the 2-year versus the 10-year. So you often hear that quoted, what's the 10 minus 2-year spread? Usually the 2-year is trading below the 10-year. That's a normal yield curve. For the past year or so, the 2-year and most of the short-term curve has been trading above the longer dated curve. So that means it's inverted. So why does that matter? Well, what that says is if I can put money in at a year and get 4.8%, and somebody's going to put it in and tie it up for 3.9% for 10 years, the market is almost saying, or they are saying, that you're going to be worse off putting your money in this short part of the yield curve long term, because what's going to happen is this short part of the yield curve is going to drop dramatically, so much so that you'll end up not making nearly as much money as you did had you locked it up. So that's suggesting economic weakness in the short side. That's all the inverted yield curve says. Since then, since 2022, you can see the entire curve moved up. So you've been hearing a lot of rhetoric how inflation has been under control, that the Fed has been fighting inflation and it's deeply under control and that inflation rates are coming down. That's not what the yield curve is saying. In fact, the entire curve is inflated up and it's about as high as it's been. And you still have a pretty dramatic inversion. Every single time we've seen a recession, we've had an inverted yield curve. And every time we've had an inverted yield curve, we've seen a recession. Now, it's not a causation, but it's a pretty good indicator. Now, 2 other indicators that come prior to a recession are Fed tightening, which we are seeing that right now. The Fed is tightening. They are reducing their balance sheet. They're, in fact, raising interest rates, which is the definition of tightening. And then what we also see is higher energy costs. So I'm going to put on white charts up here of the Brent crude, and you can see over the last 3 years that the last 3 years that energy is up. Now it spiked back here, it's coming down a little bit, but it's moving back up again, but it's up 140% over the past 3 years. These are 3 indicators of pre-recessionary things that happen that cause less economic activity. You can imagine if energy costs are higher, people have less money to spend. Companies have to spend more money to make their products. Half of production lines are usually energy costs. So if energy is up, then companies don't have as much profitability. If you are going to the gas station and you're putting too much money into the gas pump, you don't have enough to spend on discretionary other items, which is 2/3 of our economy. So that's a tax on the economy. If the Fed is tightening, same thing for companies. If their borrowing costs are going up, they can't invest in other projects. So the velocity of the money going through the economic activity of the economy slows down. That causes a recession. Now, people are pointing towards low unemployment, but we start with low unemployment in every recession, and then we get upside unemployment during the recession. It's the unemployment that ends up being a signal, not something that's preventative. It ends up being a verification. So as we get higher unemployment, that's when you'll see a recession. Any comments on that, John, at all?
No, I think it's higher oil prices, interest rates, and this graph, the inversion that you talked about, and the price action that I spoke about all kind of indicate a common theme of the future. The next 3 to 6 months may have some trouble brewing.
And so when we did the math on this, when we first saw an inverted yield curve, the time between the beginning inversion and when we see a recession, or between peak inversion and when we see a recession, or from the last time the Fed raises rates or when we see a recession, kind of all align to Q4, Q1, Q2. So, I mean, it's a big window, I understand, but in the next couple of quarters, those things all are pointing towards a recession. And I understand the economists, as of late, have been backing off this recession call. I'm just not sure why they're doing that necessarily, because I think we're going to see one. All right, so that's all there is about the recession and scaring you guys for right now. John's going to scare you guys a little bit more, talking about the federal deficit and bond issuance. So I'll let him go back to, or maybe I'm sharing.
Actually, you need to share it for page 20. Just a quick comment. Maybe this is considered informational. Maybe it helps to explain why rates have risen so high, among other reasons, the Fed raising rates. Just a quick comment. maybe I guess is more educational. So the Fed, right here at the bottom right, has the deficit here, percent of GDP. And as you can see, it's straight up and to the right on the right-hand side. And at 2023, our deficit is over the GDP of the country, which going back, what is that, 70, 80 years, has been the highest on record. And what this really shows us, and the action item behind this, is that the Fed has to issue debt, which is treasury bonds that we are buying, and I'll close the loop on that in a second, at a higher rate to give people incentive to purchase. And that's one reason why the rates that Stuart showed earlier and the treasury bonds that I'll talk to in a minute have been so attractive. The government, the US Treasury, which in theory cannot default, otherwise the entire global economic system will collapse, is giving such high interest rates. It's because the federal debt is so high, they continue to issue more debt to pay their bills. We continue to reap the benefits of this by investing in higher and higher treasury bonds. I guess you have some information at the top left here, what the government spends on. We don't got to get into any of that. But is this a pivot, Stuart, to treasury bond discussion and rates and investment of the portfolio, or do you
Yeah, not quite yet, but I think we were going to talk about the fact that because the government has to issue so many more treasuries now in order to pay for their debt, and I think the number I heard was 23% more than they were having to issue prior. It's nothing more than supply and demand. If you are oversupplied, your price goes down. And what that means for bonds, if your price goes down, your yields go up. So the borrowing cost gets more and more expensive. So think about that, the mechanics and the math. If the federal government has to keep issuing bonds, driving the price down and the yield up, that's inflationary. That pushes the yield curve up higher. So that means the Fed has to continue to drive rates up. So they're in a tough battle to outpace the yield curve and outpace the demand of treasuries while we are still fighting inflation and trying not to cause a recession all along. Because again, remember, as they're raising rates, all these rates get reset. Credit card rates get reset, mortgages get reset, bank loans get reset, investing in private equity, all that gets reset. So every single day, a new loan or multiple millions of dollars of loans, if not billions, get reset at a higher interest rate, and the economic activity becomes more and more challenging every single day.
You close the loop on that well. It's another indicator to us that higher rates mean slowing economy and higher probability of a recession.
So moving into more rosy news, here is household debt service ratio charts and flows into early delinquencies. So household debt service ratio, we're basically at a 10-year high. Now, we were much higher than that, but we just hit a credit card debt over $1 trillion, which was fantastic. And if you look at this chart, flows into early delinquencies, these are, again, at basically 10-year highs. It's not getting any better, because if you go on to this chart, the only reason why in my opinion, why the economy is doing so well is because post-COVID, there was a huge excess personal savings rate, a big spike. You can see this during COVID. People were saving money because of all the stimulus that was coming in. And this chart, this area chart, represents the amount of excess savings rate people had. Now, again, reminder, our economic driver of our economy is based off of 2/3 of personal consumption. So that's people out there buying goods and services. And they had a lot of money here, and they have whittled it down, whittled it down, whittled it down till they're basically out of money and have the most credit card debt they've ever had in their entire lives. Not great situation at all-time higher interest rates. Well, not all-time high, but multi-decade level highs. So this is not great. Again, it aligns itself back up for this kind of quarter or two of a recession. Once this gets worked off and people are faced with these higher levels of debt, then that's problematic for the economy. Thoughts on that, John?
Nope, no thoughts. You killed it. Just another action item where we're staying defensive because we see risk on the horizon. And we should probably not scare everyone. We should probably talk about some of the positives.
Yeah. All right. Well, we talked about the potential recession, right? And again, we're in the recession camp. So we're buying treasuries at that 5.5% yield, which is great. Especially, protected money. But there are indicators that are counter to what we're saying. So like there's an indicator about, you tell about.
Yeah, the one thing that's very interesting to us is that there's a lot of stats supporting the run up into a presidential election and how resilient markets are, because both the government on the fiscal side and the Federal Reserve on the monetary side don't want to shake the trees too much and make too much noise, because it could be construed as a political advantage, right? If there's one party in the office and they try to tank the economy, or that's the perception, then it becomes a really big political issue. And so we do have a saving grace where we can possibly see some robust markets. Not robust. We could maybe not see any major contractions in markets over the next 6 to 8 months. What we could start seeing is different sectors start to have a little bit of a recession, where maybe the real estate sector of the market starts to have some problems, and then energy or biotech because of higher rates, etc. And then we kind of continue to grind with the election underway. We collect some interest rates off the high treasury coupons, and then maybe in 25 we're faced with a bigger decision. Regardless, we don't want to be all doom and gloom and saying, markets are going to crash. We're very prepared for both sides. We're just trying to give you the debate that we have in our head.
Yeah, there have been very few fourth-year presidential cycles where the markets have been down. So we're kind of saying if there's a recession, the markets typically are down, but very few political cycles at this time show down markets. And then also, we've suggested that the technicals are saying that there's going to be a down market. But if we look at consumer confidence index, if you're looking at the 9 troughs, so that's where the market bottomed out, and we are just off the bottom here. I mean, we're not just, but we're coming up. Usually when you have really horrible consumer sentiment, the next 12 months is pretty good, a 24-month average return. And then when you're sitting high and glorious, really because there's no other place to go where everybody's, feeling really happy, the long-term returns are pretty dismal. I mean, 3% long-term returns is not too great. So here we've had a run-up of 17%. So we're pretty deep into this potential rally, but still it would suggest we have more rally to come, even though the technicals look like they're moving to the downside. Mm-hmm. So we have just opposing forces is what we have going on right now. All right, John, you want to talk a little bit more about like what we've been doing to prepare ourselves?
Right. Sure. Yeah, I don't think I need to share my screen. So right, we have opposing forces. We have some positives on the horizon over time. I'll share my screen and show you, just bring back up that S&P index just for a minute. So we don't want to scare people away long term, because this is what happens with the S&P index. This is a monthly chart going back over time, right? There's clear minds to be made in the markets. We're just trying to it's funny, this over here in 2011 looks like it's a non-event, but that was a 20-some% correction, and there's a lot of these 20% corrections. We're trying to protect some assets and make the ride smoother, but we do realize that over time the markets work. And so we want to have some exposure to the index. And I'm sharing my screen. Okay. So what we've done is a couple things. We've loaded up and continue to buy treasury bonds that have 3 to 6 month maturities. And this is again going back to the conversation earlier about the Treasury and the deficit, and the benefit of this to us is that we are getting very high returns on money that's air quotes guaranteed risk-free return. Although I can't say that too loosely. The Treasury would have to fail for us to lose money, which is not happening. So we're getting 5.5% a year annualized And you look back over history, the S&P, the equities market, has averaged somewhere between 8 and 10%, depending on the time frame and what you're looking at. So we're getting almost all of the up, 75% of the upside with virtually none of the downside risk. And so while we are uncertain about the outcome with the possible recession, the presidential issue, and we have these uncertainties hitting us, we park a lot of money in the treasuries. But we also, like I said, want to have the long-term upside. So what we've been doing is laddering in long-term growth notes, and these are structured notes. The one we just did, we actually found this little hack, I'll call it. Instead of pricing an option with the index option, we've priced it off the futures. Way too much info, but we've been able to generate 218% of the upside of the S&P over the next 4 years. So I'll say that again, 218% of the upside of the S&P, and we have a 30% downside protection. So let's say we do go into the worst recession we've ever seen. It'll take us 2 years to get out of it. And then if we stay there, we have 30% downside protection. In theory, you'd lose no money. But let's say we avoid that recession and it's just a little bit of a volatility for a year, but then we have another 75% upside over the next 3 years. Just a bull market resumes and AI takes over, and there's a lot of things that we're not thinking of right now. We're prepared because that 75% market return will translate to over 150% return to you. So we think that is very attractive a setup. High income treasury bonds, protected structured notes, giving you that SPY exposure. Like I said, that was a good asset class to own long term. So those are the two things that I'll point out today. And we've also been continuously using alternative assets. We've talked about this many times in many ways, but the spark notes are we turn to some private equity, some private commercial lending, and we do have some real estate, although we stopped allocating just because of the interest rates. Last year, or in 2022, the CNL that we use, the private equity fund, was up 8%, while the public markets were down 18%, and the public markets actually were down 30% at one point. So the volatility was really hidden. You didn't see any of that using the private equity structure. And this year so far, it's up 4%. So although it's slightly underperforming, you're given that nice smooth monthly income stream, and we're very happy with our private alternatives. In fact, we have other ideas on the horizon that we might start putting in the portfolios, but I'll save that for later. Did I miss anything, Stuart?
I don't think so.
We're very happy about the future. We have a lot of products, a lot of tools to help. We're very aware of the surroundings around us, onward and upwards.
Yep. One of the tools that we use, I'm going to share my screen again, is, and many people are maybe not aware yet, but we've built out this virtual family office. And what that basically means is, well, John and I are very focused on making your portfolio as efficient as possible. We think we do an excellent job at that, and happy to compare our results and our work against anybody in the field. We can't be everything personally to all people, right? So what a family office is a group of financial professionals that work together as a team for a family to optimize their wealth. Now, oftentimes that requires a lot of big payroll, but some people need some of those services some of the time, maybe not all the time. And so we have this virtual family office where it's broken into several categories. So risk mitigation, which is insurance, wealth management, that's what John and I do, legal services, that might be estates, advanced estate planning, tax planning, which we're doing a lot of we probably have more than a dozen different tax mitigation strategies that we really are focusing on working with your CPA as a team, not in a silo. So, you understand, as a team-based approach, if I was working in my silo and your CPA was doing something and the insurance person was doing something and your lawyer was doing something, we may not be doing the best optimal strategy for you, and you're kind of caught in the middle. Instead, we want to pull everybody together work on this together on your behalf and come up with a team-based solution. So that's really what we've been working on. We found some great success with that, and we'll be discussing this more in some meetings to come. So with that, we're at about 30 minutes, which is what we're shooting for. That's about all I have. Any final remarks, John, before we cut it off? I don't see any questions in the queue. So I think we are, I'm not going to say cautiously optimistic. We're optimistically cautious, right? So we are expecting a recession. We are poised either way. We're playing it defensive because we do think there's a lot more downside risk than upside potential return. But we're ready to pivot when we need to. Any
Sounds
other
great.
thoughts on that? Okay.
Nope, that's it.
All right. Well, we appreciate you joining our quarterly market call. And if you have any questions, please feel free to email either myself at Stuart@KruseAM.com or John@Kruseam.com. And we'll get to your questions as soon as we can. And without further ado, this is Stuart and John signing off. Hope you have a great day.
All right.